Many people in the United States believe the IRS aims to collect their money, but examining the tax laws reveals something remarkable. Complete portions are created specifically to compensate you for certain investments, not tax deductions, not shortcuts. The government actually provides you money when you allocate your funds into the projects they wish to see developed. I will reveal exactly which investments the IRS compensates you to make, how much they compensate, why 90% of people in the US never utilize a single one, and how affluent individuals have discreetly used these methods for a century to build the kind of multi-generational prosperity many think requires inherited privilege. By this video's end, you will see the tax law not as an instrument of control, but as a list that Congress created specifically to encourage specific actions. And if you simply choose from that list, the IRS will compensate you to live the lifestyle the government encourages. Let me begin with the most crucial idea in all of tax law, because grasping this one point makes everything else clear. The tax law is not designed for equality. It is designed to encourage activity. Every single provision in the tax law was created by Congress to direct funds toward something: homes, power, commerce, investment, retirement, learning, philanthropy. If you do what the tax law encourages, the tax law will support you financially. If you overlook the tax law and simply work a regular job and receive a salary, you pay the nation's highest effective tax rate. The typical salaried worker pays between 25 and 37% of their earnings in federal tax, state tax, payroll tax, and additional costs. The typical affluent American pays nearer to 15%, not because they have superior accountants, but because they understand the law is a list and they selected from the appropriate section. Now let me guide you through the investments the IRS directly compensates you to make. The first is so straightforward, it frustrates people when they finally learn it. Establish a business. Once you operate a legitimate business, every financial aspect of your life transforms. Every laptop purchased, every phone used for work, every trip taken for a client, every meal eaten during a business meeting, every mile driven between appointments, every subscription used to operate your business, every dollar spent learning about your field, all of it becomes deductible. And I do not mean a tiny fraction. Under Tax Code Section 179, you can deduct up to $1 million of business equipment in the purchase year. A regular worker earning $100,000 pays tax on $100,000. A business operator earning the same $100,000 can lawfully deduct many thousands in costs before the IRS calculates any tax. That is not a scheme. That is the tax law functioning precisely as intended. Congress desires more small businesses in America. They designed the rules so that the more you reinvest in your business, the less you pay in taxes. And it accumulates over time. A business operator who invests heavily in their enterprise can lawfully show a paper loss for years while actually building genuine equity and cash flow. That is the method. The second investment the IRS compensates you to make is property. I want to focus on this because it is where affluent families discreetly build multi-generational assets. When you acquire a rental property, the IRS allows a deduction called depreciation. It works like this. The tax law assumes a building's physical structure gradually deteriorates and loses value over years. For a residential property, the assumed period is 27.5 years. For commercial property, it is 39 years. So the IRS lets you take the building's value, divide by that number, and deduct it from your income each year. A $500,000 rental with a $400,000 building value provides roughly $1,400 in depreciation deductions annually for almost 30 years. That is $1,400 of income the IRS acts as if you never earned, although you did. But here's the astonishing part. The property usually does not actually lose value. Often it increases. So you collect rent, you build equity, you see the property value rise, and the IRS still reduces your taxable income by thousands each year based on theoretical depreciation that is not real. This is a phantom loss, a loss on paper that is truly a gain. It is one of the most favorable accounting treatments in the entire tax law. Now combine that with a cost segregation analysis. A professional engineer inspects your property and identifies each part with a shorter useful life than the building. Items like carpet, appliances, lighting, landscaping, and parking surfaces. Those parts can be depreciated over 5, 7, or 15 years instead of 27, letting you move large depreciation amounts into the initial ownership years. A savvy investor with $1 million rental can lawfully claim $150,000 to $250,000 of depreciation in just the first year. That is a substantial deduction against active income if you qualify as a real estate professional. Then there is the 1031 exchange. Section 1031 states that if you sell one investment property and reinvest all proceeds into another investment property, within a set period, you pay zero capital gains tax on the sale. You can repeat this indefinitely. Buy a small rental, sell it, move the profit into a larger rental, sell that, move the profit into an even larger one, and continue forever. You never pay the tax. Upon your passing, your heirs inherit the property at a stepped-up basis, meaning decades of gains are eliminated for tax purposes. The government permits building and transferring real estate portfolios without ever paying capital gains tax. This is not unlawful. It is not hidden. It is directly written into the law. Most people simply never read it. Now, to the third investment, which is rarely discussed, and when explained, you will see why the affluent are so discreet. Energy. The federal government wants domestic energy production. They want it so much that they created tax incentives so strong they seem unreal initially. Investing in oil and gas through a working interest allows deducting 65 to 80% of your investment in the first year via intangible drilling costs. In practical terms, putting $100,000 into a suitable energy project lets you lawfully deduct up to $80,000 against your active income immediately. Not over years, not gradually, but immediately in the first tax year. This is among the few investments in the entire tax law allowing deduction against salaried income. It is specifically designed for this purpose because Congress wants private capital funding American energy. If you prefer renewables, the solar investment tax credit returns 30% of installation cost as a direct credit. I must clarify a credit versus a deduction, as they differ completely. A deduction lowers your taxable income. A credit lowers your tax bill dollar for dollar. Owing the IRS $20,000 and receiving a $10,000 tax credit reduces your bill to $10,000. It is direct reduction. So, installing a $100,000 solar system gets you $30,000 back, not as an expense refund, but as a tax reduction, and you keep the system generating electricity that saves money or sells back to the utility. That is the government compensating you for owning energy production. Credits also exist for wind energy, geothermal systems, battery storage, and certain electric vehicles. The Inflation Reduction Act, despite its name, was among the largest packages of energy investment tax credits in history. It was not advertised to the general public. It was designed for corporations and informed investors who understand its use. That is this entire video's theme. The tax law rewards those who understand it and overlooks those unaware of its existence. The fourth investment category is retirement accounts. Everyone knows of them, but almost no one uses them optimally. A standard 401k allows deferring about $23,000 yearly. That is the standard employee limit. But it gets interesting. Owning a business, even a small side business, lets you open a solo 401k and contribute up to $69,000 in 1 year. That is triple a regular employee's limit. You contribute as both employee and employer simultaneously. Every dollar of that contribution reduces your taxable income directly. A business operator earning $200,000 can contribute $69,000 to their solo 401k, immediately lowering taxable income to $131,000 in a 32% tax bracket. That saves over $22,000 in tax in 1 year annually for your career. Then there is the retirement system's crown jewel, the health savings account. The HSA is the only account in the U.S. tax law offering a triple tax advantage. Money goes in tax-free. Money grows tax-free. Money comes out tax-free for qualified medical expenses. No other account provides all three benefits simultaneously. A traditional 401k offers tax-free contributions and growth, but taxes on withdrawal. A Roth IRA offers tax-free growth and withdrawal, but taxes on contributions. An HSA offers all three. And here is the rarely used detail. You need not withdraw money for medical expenses when they occur. You can pay expenses personally, keep receipts, let your HSA grow for decades, and reimburse yourself anytime later. Thus, the HSA can function as an extra retirement account with the best tax treatment available. Now, beyond the four main categories, the tax law contains smaller, lesser-known methods that can layer and multiply savings. Let me review a few used by the affluent but rarely discussed publicly. First, opportunity zones. Created in 2017, it is remarkable. Taking capital gains from any investment, stocks, real estate, cryptocurrency, business sale, and reinvesting those gains into a designated Opportunity Zone fund defers capital gains tax on the original investment until 2026. Holding the new investment for 10 years makes all gains on it completely tax-free forever. Zero capital gains tax on a 10-year hold. Designed to direct private capital into struggling areas, the affluent have used it to build multi-million-dollar tax-free investment portfolios. Second, the Augusta Rule, Section 280A. This rule lets you rent your personal home to anyone, including your own business, for up to 14 days yearly, and collect the rent entirely tax-free. Not reduced tax, not lower tax, zero tax. Owning a business and holding quarterly meetings at home lets you pay yourself $2,000 daily rent, claim a full business deduction, and personally collect $28,000 yearly tax-free. It is among the simplest and most underused methods in the entire law, completely legal with reasonable documented rent. Third, employing your children. Owning a business and having children lets you pay them reasonable wages for actual work performed. Current rules exempt children under 18, working in a parent's business from payroll taxes. If their total wages stay under the standard deduction, they pay zero federal income tax on that earnings. So you shift income from your high tax bracket to their zero bracket, get a full business deduction for the wages, and transfer wealth to the next generation while they learn real skills. A family with 2 children can lawfully move $30,000 yearly off the parent's tax return. Fourth, qualified small business stock, Section 1202. Investing in or founding a qualifying small business and holding shares for at least 5 years lets you exclude up to $10 million of gains from federal taxes. Not reduce, exclude completely. This is why many tech founders pay almost no tax upon exit. They qualified under Section 1202, and the first $10 million of gain vanishes before the IRS sees it. Fifth, the step up in basis at death. When you pass away, your heirs inherit your assets at fair market value on your date of death, not your original price. All capital gains accumulated during your life disappear completely for your heirs. Someone buying stock at $10 per share and watching it grow to $1,000 over 40 years can pass that stock to their children with a new basis of $1,000. When the children sell, they owe zero gains tax. This is how generational wealth multiplies untaxed. Sixth, the Roth conversion ladder. Take money from a traditional IRA, pay tax on it during low-income years, convert to a Roth IRA, let it grow tax-free for 5 years, then withdraw it entirely tax-free. Used correctly, this lets high earners build tax-free retirement accounts even if they exceeded direct Roth contribution limits most of their career. Seventh, the research and development tax credit. If your business spends money developing new products, improving existing ones, testing new processes, or building custom software, you can qualify for a federal tax credit worth up to 20% of those expenses. This is not only for pharmaceutical or semiconductor firms. A small software company, a custom fabrication shop, a food and beverage company creating a new recipe, an engineering firm designing custom solutions. All can qualify. The average small business owner does not know this exists. The average tax accountant does not know how to claim it properly. But companies that do have lawfully shifted tens of thousands yearly from their tax bill back to their accounts. Eighth, the backdoor Roth IRA. Earning too much for direct Roth IRA contributions still allows legal access. Contribute to a traditional IRA with after-tax funds, then immediately convert to a Roth IRA. This is completely legal. The IRS has approved it in published guidance. It lets high earners build tax-free retirement wealth that grows untouched by future tax increases yearly. You can do this every year. Most who could benefit never hear of it. Ninth, the mega backdoor Roth. This is the advanced version of the regular backdoor Roth. If your employer offers it, you can contribute up to approximately $46,000 yearly into a Roth account beyond regular contributions using after-tax contributions that convert or roll over. This can amplify your tax-free retirement account by hundreds of thousands over a career. It is among the quietest advantages in the entire law, existing only for those who ask their plan administrator if available. 10th, historic rehabilitation tax credits. Buying and restoring a certified historic building, grants a 20% federal tax credit on qualified rehabilitation expenses. Spending $1 million restoring a historic property gets $200,000 back as a direct tax bill reduction. Combine with depreciation, cost segregation, and real estate professional status, and you can lawfully build a real estate empire around historic properties while paying minimal tax. 11th, low-income housing tax credits. This is not for the average person, but having capital to invest lets the government pay you directly for building affordable housing. Credits can be worth up to 9% of your qualifying investment yearly for 10 years. The government effectively repays 90% of your investment via tax credits over a decade while you still own the property and collect rent. This is why the largest private investors in affordable housing are insurance companies and wealthy families. They understand the calculation. 12th, Section 529 plans with Roth conversion. Recently, unused funds in a 529 education savings plan can roll into a Roth IRA for the beneficiary, up to $35,000 total. So, if your children do not use all saved education money, it is not lost. It converts into a tax-free retirement account in their name. You can front-load a 529 plan early in a child's life, let it grow for 18 years, pay for their education, then transfer leftovers into their retirement account. That is intergenerational wealth transfer with tax-free growth at each step. Now, an example showing how these layer, as this changes your thinking about money permanently. Imagine a business owner earning $250,000 yearly with no tax planning, facing federal, state, and self-employment taxes. You likely give $80,000 to $90,000 to the government yearly. Over 30% of your gross income gone before living your life. Now, the same person using the described methods, you put $69,000 into a solo 401k. You put $8,000 into a health savings account. You buy a $300,000 rental property and claim roughly $10,000 in depreciation. You do a cost segregation study and front load another $30,000 of depreciation the first year. You pay your teenage children $12,000 each for real business work, moving $24,000 off your return into their zero tax bracket. You put $100,000 into a carefully vetted oil and gas working interest and deduct $80,000 of it. You use the Augusta rule and collect $28,000 in tax-free rent from your own business. Sum the deductions. You lawfully eliminated around $240,000 of taxable income. Your effective tax rate drops from the mid-30s to single digits. You put $50,000 to $70,000 back into your pocket in 1 year, annually, forever. All legal, all documented, all written into the law by Congress. That is just year one. Imagine that person layering these methods yearly. Rental properties increase in count. Retirement accounts compound in a tax shelter. The HSA grows into a hidden medical fund. Children grow with real work history and Roth accounts in their names. The business gains value through aggressive reinvestment. 10 years later, that business owner has $1 million to $3 million more net worth than if they did nothing and paid standard taxes. That is not hypothetical. That is the calculation. That results from using the law instead of criticizing it. Now, the crucial part, what I want you to remember. Most Americans never try these methods, not because they are ineligible, but because no one informs them the tax law is a list of incentives. High school did not teach this. College did not teach this. Your employer did not teach this. Your financial advisor likely did not teach this either, as most are trained to sell products, not methods. So the law remains full of incentives awaiting a reader. And most Americans never read it. Congress uses the tax law to direct money toward desired activities: businesses, housing, energy, retirement, education, conservation, charity. Each category has a bright green sign flashing. The government will cover part of your cost if you participate. The government literally reaches into its pocket saying, "Here, take some money if you will do what we ask." Most people walk past the sign complaining about high taxes. Those building real wealth are not working harder. They are reading the instructions. The tax law is the instructions. Stop treating the IRS as an opponent and start treating it as a guidebook. Once you know the rules, you stop playing defense and start playing the same method the affluent have played for a century. That is the method where the IRS compensates you. I leave you with one more thought, as it is the most important tax understanding. Most think they pay taxes as punishment for success. They do not. They pay taxes because they have not learned how the system was built. The system was built by those expecting you to invest in businesses, own real estate, fund energy, save for retirement, and build wealth. The system was built for active participation, not passive observation. Once you participate actively, you stop being a tax casualty and start being a tax beneficiary. The IRS is not your opponent. The IRS is an incentive program appearing as an enforcement agency. Seeing that sooner lets you get paid instead of paying. Read the law. Hire professionals who know the law. Invest in what the law rewards. Stop complaining about the system and start using it. Remember, every method I reviewed is 100% legal, 100% documented in plain language in the Internal Revenue Code, and 100% available to you now. Once you choose participation over observation, the IRS awaits to compensate you. You must learn how to request it. One final point. If you take nothing else from this video, take this. Every affluent family you know arrived there by understanding one thing ordinary people do not. They learned money is not earned as most believe. It is not earned by working harder. It is earned by positioning within the tax law sections Congress supports. $1 earned at a regular job is taxed around 40%. Then you spend the remainder. $1 earned through business ownership, real estate, or properly structured investments is taxed at 0, 10, or 15%. Sometimes less, then reinvested and multiplied for decades. That difference separates maintaining your position from building something generational. Decide today. Do not wait until next year. Start with one method, implement it, then add another. This is how real wealth is built. One legal tax benefit at a